So we'll be looking at the monthly outlook for the month of December. So I'll just start with what has been the index performance both in India and across the world. So as you can see, post a very tumultuous October month, the market has kind of stabilized in this market with all the major indices doing fine, just stable or flat. But you see a big deviation with respect to S&P 500 or in fact all the US indices. And that's primarily due to the Trump election and the changes that will bring about, how America is run. So it's too early to gauge the impact of, some of the policies that he might bring in. And Fed of next year would be an ideal place to understand how that go about. But some of the opportunities and the changes that he talks about is corporate tax rate cuts and bringing more efficiency in the government and so forth. Corporate tax rate cut and a strong dollar have resulted in some of the assets moving back to US, and you're seeing a very strong performance in most of the US indices. Emerging market, given the strong dollar that you've had, witnessed a decline in most of the markets, and India, as you can see, was flat. This also resulted in, pretty steep FII outflows. October was the month where people were anticipating, President Trump's, going back in power. We have seen close to about $10.9 billion of outflows during the month of October. And now that number stands around 2.2. So the number has come down. So there was certain rebalancing needed with respect to MSCI. Otherwise, that number would have been close to 3.6, $3.7 billion. But again, the FI flows, are gaining stability in that sense, where the outflows are kind of substantially reduced. But a strong dollar is a reality that we have to live with, at least in the foreseeable future, and that has implications to emerging market flows. Now, looking at some of the indices, how they have performed, the key performer was IT Index, as I said. The tax rate cut, which is being proposed by President Trump, would have, the impact of corporate tax profitability improving for most of the US companies. And we have seen in the past tenure of Trump as well, this leads to some portion being given to IT spends. And we see most of those, being reflected in some of that, coming to India as well. So we've seen in IT as an index moving up by 5.8%. Some of the index such as metals did not do so well because some of the China-led stimulus given the 2 months back not really pan out as expected. The other sectors were mostly stable or flat. Now, just coming to the key developments within India, we have seen real GDP growth, moderating quite a bit. YOY growth is just about 5.4%. And the key reason possibly is because in the past 2 to 3 years, bulk of the GDP growth was driven, in fact, by government focus on capex and government playing a significant role. But as you can see in this particular chart, but in the recent past, that number has been dwindling, and especially post-elections, there have been some, the government capex numbers have not really picked up, and part of it has been given to social schemes and so on and so forth. So we are hopeful and expecting that second half the capex numbers will pick up because the fall that we have had in GDP is quite substantial. This more or less mirrors what we are seeing in terms of the corporate results also in India. So as you can see, September quarter was one of the weakest in terms of your EBITDA profitability, EBITDA growth. So it was in fact a negative number for BSE 500, which is a broad-based index. And it kind of mirrors the lack of capex spend, the inflation pressures that some of the end consumers are facing with leading to consumption slowdown. Some of the pockets like cement, we're seeing ultra low pricing environment being shown because of excess supply as well as the demand not being there. So if you were to just dissect some of the major performers here, what is not played out as anticipated, one is of course some of the oil marketing companies and the whole energy space where the gross refining margins were low. Banks have had some issues in terms of low credit growth, but more or less the large banks are differentiating in terms of slippages numbers or asset quality. They are doing better. So our hope is this is possibly the lowest that we can see in terms of earnings, and earnings should recover as we go forward through the year. Against this backdrop, if you see the valuation still remains expensive, 1 year forward valuation still remains expensive for the market as a whole. So we are also being cautious. Our cash stands at around 16%, and we are carefully deploying into certain new sectors that the opportunity might come by. So thank you, friends. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.